What's up, guys? This is Chris. Today we are going to be talking about risk management and why it is the most important thing in trading. So the reason I feel this way is for a couple of reasons, and also it's not just me. This is across all traders, regardless of how good you are at trading. You need good risk management, and if you don't have it, you will lose. It doesn't matter how good the play is. It doesn't matter how good you are at trading. Everybody loses at some point, and if you don't manage your risk properly, it could be detrimental. So there's a reason that we say to set your stop loss at 15% every time. On average, our return on investment for each of the analysts is usually well above 25%. So you can do the math on that depending on your position size, but if you have a $100 position and your max loss you set correctly to 15%, which is just $15, and the average return on investment, let's just say, is 25, then that's pretty easy with 100, but you can see. So even if you take it early on 25%, you're making $10 more, obviously this is a negative number because this would be your stop loss, so you would be losing this. So, obviously this is greater than that number by $40, but what I'm trying to say is that if each analyst is above 80% on average in terms of win rate, and their average return on investment is 25% or better, if you are paying attention to the 15% stop loss, following the analyst plays, it's pretty hard to lose. So if you feel yourself going too big on positions, you need to sit back and understand the long game and understand, one, that these analysts are practicing proper risk management, so they're signaling these assuming that you are going to listen to them. That means a couple things. If they signal it and set their stop loss and it hits and you decide to hold, one, you aren't going to get any insight from the analyst, or at least specific unless you ask them or people are talking about it, as to what to do from there. Two, you entered a play on somebody else's analysis of that stock. So either, if you do agree with it and you did what you were supposed to do and do your due diligence on your own and agree with it, good for you. If you are entering a play blindly, which I do not suggest you do at all, but if you are, and you decide to disregard their stop loss or whatever they are saying about the play, you are going to lose. If you're entering a play and you don't understand why you are entering it, and then you decide not to listen to the person who knows why, it just makes no sense. Then why are you even trading? It's like anything in life where you are trying to either mitigate your risk or maximize your potential. And so in trading, you do that, and we do it specifically with the 15% stop loss. And yes, sometimes it sucks. Sometimes you can get wicked out below wherever your 15% stop loss is, and it rips up. And yes, that sucks, but the majority of time, it is going to save you. I promise you, it will save you. And also, it gives you a amount of loss that you are okay with entering a trade. When you enter a trade and immediately set that stop loss, if it hits your stop loss, yes, you might be annoyed. Obviously, you're going to be annoyed if you didn't make money, but you should be happy that your plan of entry, one, you should be happy that you got filled at your stop loss at a 15% loss, because if it loses 15%, yes, it can go back up, but especially on some of these short-term contracts with little time to expiration, sitting there and hoping for it to go back up is not a good idea. And you need to remember that even if the stock does go back up eventually, if there isn't a lot of time on it and theta's eaten up so much of your contract, you're going to be stuck at a loss regardless, unless this stock pulls a crazy move. And that's a whole nother thing, which I talk about in my other video about percent moves, and just understanding the reality of each stock and the reality of where they can realistically go and where they're most likely not going to go. So let's keep moving on. So also, when you're talking about position sizing, you should really only be using no more than 10% of your account. If you have a very small amount of money, say you have $200 or even $500, I understand that it's hard because there are not a lot of positions that small, and also even if you are making, say, 50% on a $20 position, you're only making $10. But as a trader, you need to pay attention to the percents. Play the percentages and the charts. Don't play the profit loss. I literally could call this the dragon philosophy. Say he enters a 10K position of $20 contracts. If that goes up $2, he has made 10% right there. And so it's a completely different type of trading when you're scalping like that and you have those large positions. But that's something you need to realize as someone who is sitting there holding only one or two of these $20 contracts. If he's trimming and selling I mean, yes, it's hard for you to sit there and trim a contract for a $2 gain, but if you can sit there and look at your percentages and realize that you've made 10%, it is much easier for you to get out of that trade. I tell everyone, look at the percentages, not the profit loss. So everyone says high risk, high reward. Yes and no. Yes, that's true. If you're taking a high risk, you're usually doing that because there is a high reward, but you can mitigate that risk. If you know you're taking a high risk, set a very tight stop loss just below the support level or the breakout level that you're playing, whatever it may be. All our analysts do this a lot. Tekka does it a lot when he's playing fib bounces or anything like that, because he knows that if it breaks a certain level, the probabilities have changed now. The probabilities are not in his favor. And yes, it could very well go back up. But he knows that because they broke that previous support level that it was honoring before, or whatever it may be, he knows he doesn't like his odds. And so that's why he gets out, and that's why you can make that high risk, high reward trade, technically not really have that much risk, even though that small amount of risk in terms of percentages, I mean, on Tekka's plays, his contracts are usually around 400, 500 plus, and the percentages on those as compared to the $100 or less is more money. But again, if you're entering Tekka's signals, you should have at least 2K, at least. You should have probably closer to 5K. I mean, there's a reason you should only enter 10% of your account, and that's because if you enter 10% of your account and worst case scenario, you don't set a stop loss and you lose the whole thing, you only lose 10% of your account. If you listen to us and do 10% of your account with a 15% stop loss, you only lose 1.5% of your entire account. So everyone who's sending these enormous losses of losing 30% of your account, 40% of your account in a day, you need to step back and understand that you are not managing your risk correctly. You need to figure out what the issue is, whether you're staying in positions too long, you're not cutting when you're supposed to be, you're not listening to the analysts, or maybe you're just taking your own plays and you don't really understand how these option contracts price it, how the prices of these option contracts is moving. Regardless of what it is, you should not see those enormous losses on your accounts. You need to understand how to manage your risk, and that could just mean you go trade pennies with Drew. And if that's it, that's awesome. Drew is amazing at what he does. He has made so much money in the last couple of weeks alone, and in his entire trading career, it is ridiculous. Trade with him for a couple days. It's really easy to figure out, pretty low risk, not very big position sizes, and these are pennies. So if you only have $100 and you're getting annoyed that the max amount of contracts you can buy is, say, like 2 or 3 on a really small play, go play the pennies. You can buy 20 shares of a dollar stock, and I mean, if that thing goes up 50%, like, yes, that's only $10, but you made a 50% gain. That's the hard part. If everybody could make 50% gains on every trade, whoever could do that would be a billionaire. They would be. Because this game is not there is no way that you can get this game down to where you are going to be 100% confident in what you are entering. Now, Tekka and a bunch of our other analysts, but specifically Tekka right now, I mean, he's, 93% accurate, and that's absurd. And that's partly because Tekka manages his risk very, very well. He cuts the losers as soon as he sees them losing, and he lets the winners ride. And that is what you need to do. If you're cutting very early and you notice that you continue to cut way before you should have, because you were either trying to mitigate your risk or you just wanted to take profit, something that you should try is maybe don't just go in and sell that position. Maybe just put a tight stop loss at like the very lowest that you would be okay with selling with, still ensuring that you're making some profit, but still allowing you to stay in the trade. You need to play the charts, play the percentages, and just don't look at the dollar value. I mean, there's a reason that if you enter an $1,000 position and it goes up $30, we're not going to be signaling trims for the most part unless we don't like it, because we're not entering $1,000 positions hoping to make $30. I mean, we're entering those positions hoping to make much more, and it goes up and down with that. I mean, bigger positions, the percentages obviously stay the same, but the dollar amounts gets larger. So that is something that you really need to sit down and understand. I really wanted to make this video just because I think mentally a lot of people struggle with understanding this concept, that yes, you might be entering a high risk, high reward play, but no, that doesn't mean you have to risk it all. Just set a tight stop loss. If you're entering a play that you know is high risk, you should not be upset when you lose a decent amount of money, because it is high risk. If you can't handle the losses, you need to either ensure that you're doing your own due diligence to prove what the analysts are telling you, or set very tight stop losses, take profits when you should, and most importantly, listen to the analysts. The analysts, especially whoever it is who signals the play you are currently in, you need to listen to them. They understand why they entered the play, so they probably also understand what would make them want to get out. So if their strategy changes and they want to get out, you need to get out with them, because whatever was telling them to get in is now gone. So I hope this video was helpful. Again, if you guys have any questions, just message me. I would love to help. And finally, just the last line, you're going to lose. You just need to learn how to be a disciplined loser. I mean, Buffett lost 50 bill or around from Corona. And like, I mean, yeah, that sucks. It's $50 billion. And Warren Buffett's like one of the best investors ever. I mean, he invests very differently than any of us do. He's like balance sheets and dividend stocks and long-term holds. But again, like, he's a very, very good investor who lost $50 billion from Corona. Yes, that's a lot of money. No, I know for a fact. I mean, I don't know exactly the numbers, but I know he has positioned himself correctly to mitigate that risk. And yes, while that 50 billion is very, very bad, and it's crazy that he lost that much money, he has way more to lose than that. Way more. And so that's just something you need to understand. You're going to lose. You just need to learn how to be a disciplined loser. But yeah, that's it for today. I hope this helped, and have a good one. I will see everyone tomorrow.